Welcome back to the What You More podcast. I'm your host, Quinton Harris. You're dialed in for episode 219. I hope each of our listeners had a wonderful, happy Thanksgiving, spent some time with your family and friends out there. I know I did. It was great to be back here in the studio after a mildly week off here. And in this episode, we're going to tackle the one big indicator the Federal Reserve follows all the time, and that's the personal consumption expenditure and what the new reading was this week. We got a reading full of all kinds of goodie bags inside there. We're going to break that down and more in this episode at What You One More. All right, so welcome back. So we're going to talk heavily about all the data that came out this week. And boy, was it a lot of it. I mean, it was like a short week, so we got everything kind of dropped on Wednesday to us. And, you know, everything from mortgage application data, job loss claims, PCE, GDP, the list goes on. But the thing I'm going to focus on here is I'm going to focus on two major things. The PCE, which is the Federal Reserve's favorite form of inflation. I'm going to break that down and why that's important and what we're looking at. Because if you recall, last couple episodes, I think it was maybe 4 episodes ago, we talked about the 200 basis point decrease that we believe is coming from the Federal Reserve and reasons why. One of them is going to be what we're talking about. And the second one is going to be the employment numbers, which I'll kind of tease on here towards the tail end of the episode. But this PCE that came out speaks to a lot of different things. One of the largest components of that is shelter cost, right? And that's housing, and we'll get into that. And it's a lagging indicator. So whenever we get a reading for the PCE, it's from the previous month. So we've got this reading in late November. It's for the month of October. And it seems to work like that with all the economic data. It's always lagging, usually a full 30 days, but it ends up feeling like 60 because you get it at the end of the month for the previous month. But one of the things we want to take a look at here is we have kind of hinted towards the fact that inflation is one of those things that it has come down so much, so quick, so fast that there's going to be these curvatures in the reading, if you may. You know, sometimes there's going to be a little bit of ups and a little bit of downs, but at the end of the day, it's going to be even kill. And that's kind of what we saw with this reading. We saw the curvature start to go up. So the headline and the core readings, the difference in the core and the headline is that you strip out the energy and food and get the core. And that's what the Federal Reserve kind of focuses on. And the headline encumbers food and energy along with the other components. And inside here, there were some contributors as to why we saw a little bit of an uptick in the core reading and a little bit of an uptick in the headline reading. And you got to remember that's because you're replacing previous readings from a year ago at this time. And we'll talk about what's looming ahead over the next 6 months in readings as well. But when you take a look at this, some of the stuff that was interesting that kind of led the whole wave there from some core monthly contributors was housing and utilities, financial services, magazines I thought was hilarious, and then new motor vehicles. And that could be that could be insurance, that could be the cost of new motor vehicles, but all of these things kind of led the way. And then again, shelter being one of the larger components on this. So, you know, while inflation's progressed, it's kind of stalled. And like I said, it's kind of that on that curvature of going up here, got in the wrong direction. You know, we did anticipate this. We've talked about it. But as we start replacing these figures, it's going to happen when you're replacing lower numbers. And I'm just going to take a chart here and I'm going to put it up on our YouTube channel at What's Your One More with the number 1 at What's Your One More. If you're not subscribed to our channel, please do. Love all the comments and feedbacks you guys give us on there, especially to our producer, Charlie, who does a great job with this. But take a look at these replacements on here. I'm going to point out November of 2023 all the way through May of 2024. That's the previous years that we're replacing. So if you look at the benchmark for the next upcoming 2 readings, because we're going to get a reading December for November and January for December, you get the point here. We're really not going to see an opportunity to see that PCE get lower until that February reading for the month of January, where you start replacing some bigger numbers, and that's when we're going to see the windfall. So I guess where I'm going with this is you may see headlines that say, hey, inflation's creeping up again. Maybe we're back over 3 on that core reading. Don't get fret about that. It's because you're replacing such lower averages as you come into these next months. And I guess what I'm saying is we should expect that. You should expect that, right? And I don't think that's going to negatively impact the Federal Reserve and their thought process on those 200 basis points being a quarter. Matter of fact, we had 2 Fed members come out over the last week and said, I think we need to be a little more aggressive in our reduction of the interest rates. And I think that's important because we'll talk about that in the next episode of those Fed minutes and what we saw with, for the first time, all Federal Reserve members on the same page about reducing the rates. And I think that's a sign of things to come. But one of the things inside this is the shelter component. I was talking about that here. If you look at it, it's the biggest contributor to the inflation. It's up 5% year over year, which is much hotter than the real-time reading. Because if you look at CoreLogic's reading, which is more real-time, it's along the 2% right now. And this kind of lagging data they have, because remember, it's past 12 months, it's showing it's a 5%. And because of its weight being so much in the weighted average of this component, it's driving up this PCE higher than what it should be. And if it was caught up to real-time, the actual PCE reading would be around 2.3, not 2.8, if you use the CoreLogic real-time reading on that. But if you recall, Jerome Powell said, hey, we're looking at a 3-month run and a 6-month run of the core PCE. And so we like to look at those runs as well. And if you look at the 3-month run rate, meaning if you just took the last 3 months of the PCE core reading, it's a 2.77. But if you look at the 6-month run rate, it's a 2.3. Remember, the Federal Reserve is trying to obtain a 2% target rate inflation, and they're there. They're there. You could argue based on what I just said, it may go up a little bit, but I think that they know that's coming. But speaking of shelter, one of the major things that we had happen this week was the announcement from the Federal Housing Finance Agency stating that, hey, listen, our loan limits are going up on the conventional side of things. Now, this is a big win if you're in the lending world or if you're looking to be a buyer, because each year loan limits are evaluated to see, do they need to remain the same? Do they need to go up? And why would they go up? Well, they would go up because that index is going up each month, and the differential between last year and this year is how they determine a portion of they're going to raise the conventional loan limits. Well, just to kind of give you some historical background on this, when I entered the business, the conventional loan limit was $252,700. So that means you could do a conforming loan for $252,700 for a loan. In 2006, it jumped to $417. But for 10 years, it remained at $417 until 2016. And so it doesn't, I guess I share it with you because it doesn't always go up. And for 10 years, it didn't go up. And we know why that didn't go up during that time. That was that real estate era that we talk about that was such a hard one to get out of and navigate out of. But we didn't see an appreciation rate and we didn't see a growth rate in that index to support that. Well, since that time, in 2024, those loan limits have jumped to $766,550. And we just found out that 2025's loan limits are going to be $806,500. Nearly almost quadrupling that 2000 from when I started in the business in here. And in 2016, doubling where we were from 2016. So massive growth. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejax.com. That's loanpeoplejax.com. Housing is not a bubble that is going to collapse, and it's not 2006 all over again. And even when you see the agencies, these are the government agencies, this is Fannie Mae and Freddie Mac coming out and saying, we're going to increase loan limits on across the board on housing from 1 family to 4 families. It's because they need to create more lending opportunities for people to say, hey, listen, the home price is X. We need to be able to do a conventional loan with lower down payments, and we need to be able to offer that to people. And obviously, based on the region of the country you live in, you may see some alternative loan limits being higher, high-cost loans. But for the most part, this is going to cover the bulk of America. Now, if you're looking at FHA loans, it's a little slightly different because those are going to go county by county. And inside of this episode on our YouTube channel, What's Your One More, I'm going to have my producer, Charlie, put the county link in there. You can click on that link and then just choose the state you live in. You can see all the counties in that area. Just isolate it down to the county that you want, but it'll give you your loan limit. For example, here in Duval County, where we're doing this podcast, our loan limit in 2024 is $564,650. Well, it's jumping next year to $580,750. So pretty good win there, $15,000 jump there for us. And this is in an FHA market. So that's pretty impressive because, again, I know that going back to when I started in the business, as you can tell, 20 plus years ago, that number was in the 200,000 range. So you're seeing significant growth across the board because, again, housing is going up. Housing is not coming backwards. And this is just another sign, another, you could say, a piece of evidence that we keep talking about over and over again about housing is not in this depressed bubble that is going to burst as much as the internet wants you to think that, or the people on YouTube want to talk about it for clicks. The data doesn't suggest that's correct. And more importantly, it shows that it's continuing to go up. And again, it might be going up at 2%, but it's not going backwards at 10. It's not collapsing at 20. And these are things that we continue to fight off and defend here on this show over and over again. But I know I sound like a broken record. I just want our audience to understand that this is a very valuable tool. And I shared I shared it all at the beginning with the PCE because that's how we measure inflation. And if the largest component of that is shelter cost, now again, it's lagging, hasn't caught up, but it's going to show you, it's showing us that the data is correct in the fact that housing continues to go up. Now, there's other things you could say inside of that shelter component. There's owner's equivalent of rent. We've talked about what that is oftentimes. I'm not going to go through it again, but the whole phone call, hey, what would you rent for your homeowner? What would you rent your home for? Obviously is not the most accurate way to do it, but it's a standard they've been using for a long time. But I'm not removing rents from the equation. I'm talking about pure housing and the price of it going up and why it continues to go up. And we talked about many times what's going to cause it to continue to roar, might even be greater than what it's doing right now. And those two things would be lower rates, and then we would have to see a situation where some of those unlocked loans come to the table and people start selling their homes because more buyers have come to the table because affordability is there. And then you're going to have that musical chair situation we continue to talk about on here over and over again. So the last highlight of this I want to talk about was the jobless claims reports that comes out. Now, the reason I bring that up is because at this point, I believe listening to Jerome Powell at the podium and listening to the Federal Reserve members talk outside of the official meeting, they all keep going towards one thing, and that's maximum employment stability. And they want to make sure the job market is not becoming too weak, right? And they continue to say that it's a very stubborn job market that has continued to be resilient and hold the line. And in the jobless claims reports, they are now acknowledging, they being the Federal Reserve, they're now acknowledging we're watching the jobless claims reports. They're tuning into the continuing claims. And these are things they haven't really admitted that they've been looking at. We know they are, but now they are admitting at the podium and outside the meeting. These are numbers that are important for the direction of how they want to, decide to loosen up, the Federal Reserve loosen up the tightening of what they've done here. And so reducing rates, and a lot of that depends on the job market. And when it's resilient and continues to show signs of, not really cracking or breaking, it could maybe cause the Federal Reserve to maybe loosen at a longer duration than a quicker one, meaning that 200 basis points, that I forecasted could come over the next 8 meetings quarter. But if that job market was to crack, and that job market was to show signs of not being as resilient, you might get that in a 4-window meeting instead of an 8-window meeting. You may see 50-50, 50-50. So it all depends on what this market's doing, and that's kind of why I wanted to bring that up here to kind of close out this episode, because there were some things in there to me that were interesting. One of them was being that the continuing claims continued to go up. Like you lose the opportunity to get those if you haven't found a job to replace the job you lost over a certain amount of time. You can't stay on unemployment benefits for the rest of the time you're unemployed. You can't just sit back and say, hey, I'm never going to get a job. I'll just collect unemployment. That's not how it works. But the continuing claims are offering some insight that I think are important because they have reached a number that's a 3-year high dating back to the COVID period of 2021. That's interesting to me because that means two things. It means employers are holding on to employees longer. Like, for example, if Charlie, my producer, was going to get recruited, and you may be experiencing this, in your workplace, but if Charlie was being recruited today, unless someone's willing to pay Charlie a lot more money to come work for them, Charlie don't get any ideas over there, but if he's going to go work for someone else, then Charlie can go willfully say, I'm out, I'm going to go take that job, and that employer's going, yes, hey, I got a great producer, this is awesome. But in today's world, what these numbers are showing us is that people aren't making that phone call in this situation. They're not recruiting as hard, and employers are holding on to employers are holding on to employees longer because the other job opportunities are not there. And then the other thing we're seeing is that when an employee is let go, it is much harder for that employee now to find a job to replace the job that they lost. It's not as plug and play as it once was. So you're seeing continuing claims rise, and you're also seeing employers hold on to their employees longer. The other thing you'll see is that for the first time, I believe I can say this, for the first time, our savings rate is increasing in America because the jobs are paying more. You're seeing more money being made right now, but less spending happening. And that's a positive sign for the economy. That's something that we've needed to see that we haven't seen really since COVID. And it's up to 4.4% right now from 4.1. That's important. But going back to the job thing here, I think if those continuing claims continue to go up, I think what we're seeing with, let's get out of the seasonality, right? We're in the season right now where you're seeing multiple jobs are being hired for, the Christmas time, the holiday time in retail. I think once all that phases out and we get into mid-January and we start getting some of these numbers coming out of the holiday season, I'm willing to bet that the continuing claims numbers start to go up. So do the jobless claims numbers go up each week when they come out. And I think that's what's going to kind of spur, if you may, this Federal Reserve moving that 200 basis point needle a little faster than the 8 months that I think they would like to do, though. So we'll tune into that and watch. But guys, thanks for dialing into this episode. I hope, again, you had a great Thanksgiving with your family. If you would, please share this podcast with a family member or friend. We'd love some feedback. 5-star review it on Apple or Spotify. Ultimately, please check us out on our YouTube channel at What's Your One More. That's with the number 1 at What's Your One More. Till the next episode, we'll see you guys at What's Your One More.
Got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one